Hello, everyone, and good afternoon. My name is Alan Schoenfecker. Thank you all for taking this time this afternoon to join us for our webinar. Uh, my name is Alan Schoenfecker. I'm the co-founder and the CEO for ShareEstates.com. We're here today to discuss on our webinar some of the benefits of real estate investing and how to underwrite deals like a pro, as well as some comparison to alternative investments. We also want to discuss why all of this is important. After all, real estate is a complex asset class, and most people, frankly, never have an opportunity to gain exposure. And those that do need to understand how to properly review deals to maximize their experience. We'll also be sharing some tips with you during the course of our webinar, and we hope that we find the information here very valuable. Along with myself for the panel today, we have Richard Wisniewski. Richard is ShareEstate's Chief Investment Officer and has 35 years of experience in investment banking in consumer and commercial assets. He's also one of the founders at Brooklyn Park Asset Management and co-founded Rediscount Lending for Fortress, as well as launching a loan funding program for Lending Club, and has now been with ShareEstates for about 6 years. We also have joining us Daniel Williams, who's the co-founder of Kilgore Williams Capital, founded in 2009, which is a Toronto-based investment management firm that specializes in small balance loans originated by U.S. online marketplace lenders like ShareEstates. He has over 20 years of experience in a variety of credit markets and is a true expert in real estate lending and investing. For the purposes of our webinar today, we're going to start with a little bit of a background. Why is right now the right time for commercial real estate? In this background, we want to assess the current rate environment, the countercyclicality of real estate, and what the future holds for rates as a whole. So starting with rates, I'm going to actually kick this over to Richard. Richard, tell us a little bit about why we're in a great rate environment now, and what does that mean for our investors?
Yeah, so this is probably the highest rate environment we've seen across the yield curve in a long time. And it's a great environment for investors because I think there's an anticipation that the rates will be coming down at some point in the future. That may have been pushed back a little bit further down, towards the end of the fourth quarter, maybe even the beginning of 2025. But I think there's definitely an anticipation that rates are coming down. And so investors are really looking to direct a lot of their capital into the real estate markets, which right now have really great returns on some of the loans that you can invest in. And they're looking to do that and redeploy that capital there to lock in the high rates in advance of the expected rate cuts. So we're seeing a lot of that activity across the board. And I suspect that will continue until the rate environment starts to change.
Yeah, I'd add to that, Richard. When we started in this industry and launched ShareEstates back in 2015, we were in a similar rate environment. I think our initial loans were generally being lent at rates between 11 to 13%. And over the course of the last 9 years or so, we actually saw a lot of rate compression. I think as ShareEstates and platforms like ShareEstates institutionalized this product, a couple of things were happening. We were seeing more liquidity come into the space, more institutional capital come into the space, ultimately creating a lot of competition and a lot of yield compression, to the point that I think our lowest bridge lending rates were actually going out with 7-handle pricing, believe it or not, and rates to investors in the 6% range, 6.5% range. Now looking back at 2024, 2023, over the last couple of years since the Fed started hiking rates, we're back to that same 11 to 13% environment where, in my opinion, I agree with you. I think investors should be looking to lock in those rates because, frankly, I don't know how much longer this rate environment's going to last. And Dan, I'm going to switch over to you now. As far as countercyclicality, I mean, you and your firm invest not only in real estate debt, but also in consumer paper and business loans as well. Talk to us a little bit about the differences between those assets, what sort of countercyclicality you believe exists within real estate relative to those assets, and how you guys generally would manage your portfolio between those three asset classes.
Sure. Thank you. Great question. We manage our portfolio and the allocation of our portfolio kind of over time and space throughout the credit cycle. And what we've seen kind of in the post-COVID era it's right. We also invest across three asset classes, as you mentioned: consumer loans, small business loans, and real estate development loans, like the ones that you guys originate. What we've seen coming out of COVID is higher. At first, there was everything was performing very well because the COVID stimulus programs kind of flooded liquidity into the market, and whether that's consumer lending or other areas. The consumer portion of our portfolio had a delayed COVID reaction, if you will, that took a couple of years to exhaust the household balance sheets for the programs to unwind. And also they got hit with a double whammy of higher rates and higher inflation. So we've seen higher delinquencies in our consumer portfolio. In contrast, we're cycling into more secured lending and therefore more real estate because of a couple things. One is where we're in the rate cycle, and your observations about rates being quite high, and it's an opportunity for us to lock in those rates for a reasonable period of time. And secondly, being in secured lending, where there's a hard asset as a source of recovery when we're slowing down the economy, when the Fed is literally slowing down the economy, it seems like a savvy or at least wise move from our perspective.
Awesome. Thank you for sharing that. So I think the idea here is, realistically, nobody knows when the Fed is going to actually reduce rates. There's a lot of theory out there. I personally watch CNBC every day to try to understand when I think it's going to happen. But right now, I think the market is pricing in about a 74% chance that we'll see maybe 2 rate cuts this year. That being said, I think once those rate cuts start coming in, we'll probably see a fair amount of liquidity return to the market and probably see some pretty quick compression on these rates. So again, if you haven't already pulled the trigger, now's a great time to be looking at this, where you could be getting 11, 12, 13% rates. And I don't think those rates will be there this time next year. Moving on to a little bit of a different background. So real estate is a massive asset class, right? It's one of the world's largest asset classes. Within that, there's different complexities. There's different segments of real estate. So on that topic, we've got asset classes within real estate. We've got development phases within real estate, but we also have geographic diversity within real estate. Rich, what are your thoughts on the geographic diversity, and how should investors be thinking about where to invest their money, whether it's the East Coast, West Coast, Midwest, or otherwise?
Yeah, so I think geographic diversification is extremely important. As you alluded to, markets perform differently. We see different rates in different markets. There are different valuations for real estate in different markets, and frankly, different levels of value appreciation in those markets as well. And so, in terms of diversification, I think it's probably wise to think about, kind of spreading your investments across different regions, different states. One of the things that I think is really, really important that an investor should consider when they're investing in different states is whether a state is a judicial or a non-judicial foreclosure state. And what that really means is that, in the unlikely event that you have to enforce against a defaulted loan, in a judicial foreclosure state, you would have to do that by effectively prosecuting that foreclosure in the court system. And, that process can take anywhere from 18 to up to as much as 36 months to complete. While in a non-judicial foreclosure state, that time frame is more like 3 to 6 months. So it definitely has a marked, difference from a cash flow perspective on when you can basically realize on your collateral on a defaulted loan. Now that is actually in most cases priced into the loan. So loans in different markets, depending on whether they're judicial or non-judicial foreclosure states, definitely priced differently, for that risk. And so, it's definitely something that should be considered, especially if you're assembling your portfolio and trying to diversify that, by geography.
Right. So what I'm hearing is, don't always chase the yield. Get some diversity in other states, even if it comes with a lower coupon, because inevitably there will be some level of defaults, and there's a benefit to being in a non-judicial foreclosure state. and frankly, in other geographies where you're going to see some risk mitigation from regional events.
That's exactly right.
And Dan, tell us a little bit how you think about asset classes and even possibly development phases as you guys manage your portfolio and make investment decisions.
Sure, absolutely. When we look at loans, we look at the project budget and how much of the upside is going to come from that project. And honestly, we're a fairly conservative investor, and we look for projects that aren't where the development phase is relatively contained, and we're not taking a ton of risk to the development phase. So we like to do things that are shorter term. We tend not to do ground up construction, and we don't do big buildings. So we like to focus on single family and small multifamily. And we don't do a lot of commercial. Occasionally we'll do some mixed use. And some of that's risk avoidance from our perspective, and some of it's straight up perspective. So there's a flavor for everyone, really.
Yeah, and so again, I mean, real estate's a massive asset class. There's subsections to that. So you've got your residential market, your multifamily and mixed use market, and then you have your true commercial markets like retail, office, hospitality, industrial. And then even within those segments, there's subsegments, right? There's warehousing, there's industrial development. So there's a lot of different ways you could look at real estate. We also similarly at Share Estates have really chosen to focus more on residential component assets. So typically what we're looking to finance are 1 to 4 family properties, as well as small multifamily and small mixed use assets that have a residential component of 50% or more of the square footage of the building. And our theory there is simple. People always need a place to live. The residential housing market is hot. We have a shortage of residential housing, and there's a ton of demand for it. Whereas we've seen, granted, there are benefits to it. We've seen the shortcomings of other commercial assets like office, like retail in environments like COVID and otherwise. But people always need a roof over their heads, right? And then as far as the development phases, similarly, right, for everybody's benefit, we like to think of this in 3 buckets. There's ground up development, there's value add and rehab, and then there's stabilized assets. A lot of the lending that we do at Share Estates is really focused around the value add rehab properties, and to some extent, some ground up construction, but also some stabilized bridge lending as well. So to your point, I think there is more execution risk when you're looking at ground up development. Again, you will see that translate into a better rate product, but you don't always want to necessarily just chase the yield. You want to get a diversified portfolio where maybe you do take some ground up risk, but also you want to look at those stabilized and rehab assets at a lower coupon.
And they tend to be longer term as well, right? So
absolutely.
Yeah. So
absolutely.
We have a liquid fund with redemption options for investors, so we tend to keep things really short.
Okay. All right. So moving on to the next segment of our webinar here today, we've put together some tips for everybody's benefit. So the first one, Dan, I'd actually like to kick off with you. When you're looking at your portfolio, what do you think is one of the most important components of how you manage that portfolio?
Well, I mean, Richard already stole my line, which is that we love diversification as a credit manager. There's an old saw that diversification is the only free lunch in investing. Not my expression. That was Harry Markowitz. But we're keen on diversification by geography, as Richard was talking about, also by number of loans, and also by number of developers. So one of the things that we've learned is to avoid concentrations of risk in any of those categories, including the builders and borrowers that we work with. So one thing to look through when you're selecting loans is, even though they have different addresses and may have different corporations that own the property or is in development, look all the way through to who's providing the personal guarantee and who's swinging the hammer.
Yeah, no, that's a great tip, and I think oftentimes investors will lose sight of this when they're doing well with a particular borrower or they're doing well in a particular geography, and they say, why go learn something new? Why take the risk on something else? if I'm doing well with what I'm already doing? And the answer really is diversification, because you never know what's going to happen to that developer. You never know what's going to happen to that geography. So there's a reason this is an old saying, right? Diversified portfolios are the key to success. And Rich, moving on to you, I know you've got a couple of tips for us today, so please take it away.
Yeah, so the first one I think is really important, and that's borrower credit and liquidity. And that really gets to the probability that the loan is going to perform and that the project is going to get completed. The viability of an investment is very, very highly correlated to those, to the credit quality and liquidity of the borrower. So we do a lot of things in underwriting, including credit checks, background checks, and other things to verify that liquidity and that credit quality of the borrower. So the kind of things you want to know are, do they have a good credit history? Are they delinquent on a lot of things? Have they defaulted on other accounts? Do they have charged off accounts or bankruptcies in their background? Some of the things that you can find out from a background check are whether they have any material litigation, and that would be, potentially with other lenders or with service providers. Do they have issues with municipalities or government agencies? All of those things really speak to the credit of the borrower and the probability that they're going to perform. You want to also know that they've, managed their cash flow effectively in the past. So, you want to see a good pattern of, delinquency being, next to none. And you want to know that they, they've always been able to manage, their business well. One of the things that, is really, really important and something that we focus on a lot is whether the borrower has verifiable available funds to complete any construction or rehabilitation that's required for a project. And that, really is speaking to whether or not they can actually complete the budgeted construction expenses, because we're not going to be advancing any funds to them until those, parts of the project are completed. And that really gets to the heart of whether or not they can complete the project and perform on the loan. So we do a lot of things like looking at financial statements and other financial documents, again, to verify that the liquidity is there, and it's available, to complete those tasks in the budget.
Yeah, and I think that's an important note for everybody's benefit is there will undoubtedly be surprises in any project. You open up a wall that you might find mold. You might be buying an asset, a larger multifamily asset where you haven't had the benefit of actually accessing every single unit. There's always going to be variations, right? And so making sure these borrowers have the right liquidity, and not only in the form of cash in a bank account, but verifying the source of that cash and that they actually have availability to use it, becomes really important to make sure that when those surprises do show up, the borrowers actually have the capacity to complete the renovations prior to coming to us for a draw request to fund their next phase. And then moving on from that, Rich, what do you think is the second most important factor when looking at these deals?
So I think, equally important is the value of the underlying property. And it ties, very closely with what I just discussed, which really gets to, the probability of default on a loan. And then if it does happen, what the value of that property is. And so there are a couple of ways to get at that value. We do full appraisals, that you can also do a arguably less accurate and less comprehensive, desktop review or broker price opinion, which is referred to as a BPO. But we on every loan that we do a full appraisal, because we want the best the best estimate of value that we can get for the property. And so what do you look for in an appraisal? One of the most important things is that the appraisal should be FIRREA or agency eligible or compliant. And that's all stated, right in the appraisal if you read through it. The appraisal should be prepared by an independent third party MAI designated appraiser. And when I mean independent, I mean independent of both the lender and the borrower. So this appraiser has no affiliation with either entity and is doing this on a totally independent basis. Appraisers should be qualified also for the project type that they're appraising and the market that it's in. That's very important to make sure that, you know, they consider all aspects of the project when they're making their value determination. Appraisals also typically include an on-site evaluation of the property and the neighborhood. And they look at not only market comps, but also, in a lot of cases, the cash flow at a market cap rate and the cost of the project in determining that value. So, you know, they can get at different things like, is the project appropriate for the location? Is the value an outlier for the market? You know, is the builder building a luxury apartment in a middle market scenario? So again, we do a full appraisal to get, you know, a view on all of that, and with all the requirements that I just listed on every property that we make a loan on.
Amazing. I'd add just 2 points also, which is that not all appraisals are created equally. The comps are really important. So appraisers can make anything fit at the end of the day. They shouldn't, but they can. And it becomes really important to be looking at those comps, two specific factors. What's the age of the comp? What's the distance to the subject property? So oftentimes we actually will see appraisers going out further than we would like to pick comps that might be appropriate from a size and comparison standpoint, but frankly are just in not a different zip code, but in an urban city too far, right? You don't want to go out a mile in an urban city when you should be going out maybe a quarter, max half a mile. And the other factor is of course also the age of the comp. Real estate comps are inherently retrospective. They're looking backwards to see what recent sales have been. And so ideally, you want to be looking for comps that have happened in the last 3 to 6 months. If you find yourself with an appraisal that's looking back further than that, I would call into question the quality of that comp, the quality of that appraisal, and probably just ask more questions around it before you make an investment.
Alan, I'm enough of an old school capital markets guy that often the best reflection of value is price. So
yes,
the most accurate comp often is the most recent purchase price of the property in question. So that's something that we always look at.
Absolutely. So I've got a couple of tips here as well. One of the most important things, in my opinion, is skin in the game. So when we think about looking at a property's value, what Richard was talking about earlier was really kind of 2 components. It's loan to value of the property's condition as it sits today, and loan to as completed value, or loan to after repair value, which is what is it worth after the actual rehab is done, the business plan is completed. But there's a third measure that ties back into liquidity to some extent, which is skin in the game. We've been in a highly competitive market where we've seen lenders inching up on loan to cost. When we first started lending, we were out in the market at 75, maybe 80% loan to cost, meaning that the borrowers had to bring 20 to 25% of the deal, of the cash required for the deal, to the table. Over the last decade or so, we've seen other lenders stretching to 90, 95, in some cases close to 100% loan to cost, meaning that effectively the borrower, the guarantor, doesn't have much of their own cash at risk. And we've seen that translate in a number of different ways. Sometimes, of course, it works out. But in the event that there is an issue, that there is a delinquency, that borrower is typically more likely to walk away because they don't have any of their own money at risk. So really important here for those of you listening, look at loan to costs, make sure that the borrower not only has liquidity, but that they're actually putting that liquidity at risk in the loan when they're doing that deal. And finally, borrower experience. It is my opinion, some will agree, some will disagree, hopefully most of you agree, that a good operator can turn a bad asset into a good one, and a bad operator can turn a great asset into a bad one. The operator is important, guys. Their experience, their track record, their verifiable track record is very important. Making sure that these borrowers have actually conducted a similar project in a similar market of a similar scope is important. What I mean by that is we've had borrowers come to us that have done predominantly residential 1 to 4 family fix and flips. and they're now starting to dip their toes into ground up multifamily construction. Two completely different animals. We've also similarly seen borrowers that have had amazing track records in a particular market who have decided for their own diversification purposes to move to a different market, spread some of their risk around. But the reality is that they don't have the same relationships, they don't have the same infrastructure when it comes to property management, when it comes to construction vendors, frankly, when it comes to getting approvals on a project. And so making sure that your borrower has experience not only in the particular asset class, but in the geography that they're operating in is extremely important in making sure that that borrower can actually successfully complete that project. A couple of things that we do to verify track record are things like collecting REO schedules, real estate owned schedules. And then we take it a step further by requiring some proof that the borrowers actually transacted on those properties. So we'll look to collect HUDs, we'll look to collect closing statements, rehab budgets, showing what did the borrower buy the property for, how much did they spend renovating it, and ultimately how much did they sell it for, or were they able to refinance. So not only are we looking at addresses on a piece of paper, but how have they actually successfully turned over that project to reach the necessary experience requirements we have at Share Estates. So that is it for the tips portion of our session today. We're starting to run low on time, so I'm going to kick it back to Richard for a few moments to just give a little bit more information about Share Estates and our history, and we'll see where we go from there.
Sure. Alan, you could flip to the next slide. So Share Estates is a national private lender. We were established in 2015. And our mission, since inception is the democratization of real estate investing. And what that really means is that we've designed our platform to bring together real estate developers and owners and investors who want to participate in the real estate markets. So how we do that is we make non-owner occupied loans for the development of real estate properties. And we also run an online marketplace for investing in those real estate loans. So for all the people listening, it gives you an opportunity to invest in loans very similar to way the institutional investors in the market are buying loans as well. Some of the stats you see on the screen, just about the company. We've originated over 4,000 loans since inception, and that's actually translates into now over $3.6 billion in loan volume. We've returned 2.2 billion of principal back to investors. So all of those loans were sold, and a lot of them have gone through their life cycle, and we've returned principal. The average loan on our bridge loan product is about $900,000, and that has typically a 12 to 18 month average term. And as Alan was pointing out earlier about the leverage, the day one LTV on most of those loans is about 67%. So for those of you who are looking to invest in our loans, what we do on our side is our underwriting team uses a proprietary underwriting system to evaluate loans in addition to, the work they do as underwriters. And we do, as we discussed earlier, the developer and property level assessment for each loan. So that's really done, obviously, to ensure a strong credit performance. And it gets at all the things we talked about earlier, making sure that, the borrower has skin in the game. We verify the borrower experience. We verify, credit and liquidity, and we assess the credit and collateral value. And if you look at some of the things, that are on the screen, you can see all of the things that we focus on in terms of our assessment of the property value and of the borrower credit. Our website actually also provides all, information, easy access to this information for every project so that you can make an informed decision about your investment.
And in closing there, guys, I would just add that our democratization of real estate investment, our mission in democratizing real estate investments comes in two forms today. So if you register on our platform, you'll actually be able to choose between two different product types. One is an individual portfolio selection, meaning you can actually see and pick individual loans, as well as all of the characteristics of that loan at the property level, at the borrower level, and invest as little as $5,000 in those deals, build your own customizable portfolio. And the second is our fund product, our high yield credit fund, where we take a part of that process out to make it a little bit more passive for you, where you're investing in a pool of assets that we will then be picking and selecting and putting assets into that pool, with those assets actually turning over more frequently over time as those assets are then sold off to larger institutional investors. Both products provide generally a passive experience. Share Estates is doing all of the loan servicing and asset management on those products. So once you register and invest, you'll link a bank account, you'll receive monthly reporting and distributions, and our team's always here to answer any questions and help you through that process. You could visit our website at www.shareestates.com or take a snapshot of that QR code. And we thank you for joining us today, giving us your valuable time, and we hope you found this helpful. Thank you for coming.
Thanks, Al.